welcome everyone to the session this afternoon. I want to thank all of you for coming out. I know it's a busy time, especially as we enter into the fourth quarter of the year. We're excited to be partnering with CFA Society Boston on this alternative investment series, and really excited to be talking about private equity, which has certainly been an area of focus for a lot of investors and has certainly grown quite exponentially over the past several years. My name is Aaron Filbeck. I'm Managing Director and Head of UniFi by CAIA. At CAIA Association, I'm thrilled to be moderating the session this afternoon. Before we get into the meat of today, I thought I might just share a little bit about CAIA Association, who we are, and a little bit about our stacking program, which I know is something that is available to many CFA charter holders around the world, including members of CFA Society Boston. So for those of you who don't know, CAIA is a professional body, a professional association focused on education in the world of alternative investments. We have about 13,000 members all around the world, representing about 100 different countries. And we've got members that are in multiple asset classes, from public to private capital, hedge fund strategies, academics, regulators, and so on. And so when you look around kind of the membership, it's very representative of the different asset classes that we cover on the exam, and for those that are part of the association. For those of you who don't know, we do have a program called the Stacking Program, which is available to current CFA charter holders. So if you're interested in topics like private equity and some of the other topics that we've covered in this series with the Boston Society, we think that this program will be very interesting to all of you. CFA Stacking Program allows those of you who are in good standing with the Institute to actually move past level 1 of the exam and go straight into level 2. So it's a nice kind of continuation of your education, focusing on the world of private markets and alternative investments. So if you have questions on this, please let me know. We're happy to follow up with any information that might be relevant to you. So without further ado, let's get into today's topic, which is private equity. And I think we've got a lot of interesting things to talk about with Steve McCourt and Meketa. So if you have questions throughout the session, please feel free to use the chat. I'll try to integrate as many questions as I can throughout today's discussion. And then if we have time at the end, we'll certainly dedicate a portion of our discussion to asking Stephen some further questions. But maybe just as a little bit of historical context and kind of why this is so relevant today, alternative investments represent roughly 20 to 21 trillion in assets under management, as measured just by AUM and institutional portfolios today. And about half of that is private equity. So we're sitting right at 10 trillion US dollars in assets under management. And that covers all the different flavors of private equity, from venture to growth to buyout strategies, secondaries, and so on. So it's a very quickly growing, quickly evolving, and very diverse asset class. So there's a lot to talk about that's very timely in today's markets. Stephen, before I get into my line of questioning, I'd love for you maybe just to spend some time introducing yourself, talking about your firm, and maybe what's top of mind for yourself.
Great, thanks, Aaron. And maybe starting with a quick introduction to Meketa and myself. Meketa is a large institutional investment consulting organization. We have roughly 250 institutional clients that we serve across the country. And we advise assets of roughly $1.7 trillion. Our clients are by type fairly diversified across the institutional world: public retirement systems, Taft-Hartley defined benefit plans and defined contribution plans, corporate pensions and defined contribution plans, and endowments and foundations. That's been the core of what we do as an organization, advising those types of clients for the last 45 years now. Our headquarters is in Boston, so it's nice to be speaking to this chapter. I am co-CEO of Meketa Investment Group. I'm actually based out in San Diego, where we have another large office. And I've been at Meketa for 29 years. Part of what I've done over that time, or started 23 years ago, was the development of our private equity practice with our clients. And so private equity as an asset class has been close to me for a long, long time. I've been involved in the asset class at Meketa in a variety of ways, from diligencing general partners and funds to advising clients on how to approach the asset class most efficiently. And 20 plus years later, it still, to me, represents a vital part of any institutional investor's portfolio if their goals are to achieve the highest risk-adjusted returns. I'm sure we'll get into a lot of our rationale for that over time. Meketa provides advice to clients across literally every single asset class, and we also advise clients on asset allocation and risk management. So we have a total portfolio perspective in our work that we do. Amongst institutional consulting firms, we have a particular expertise within the private market categories: private equity, private credit, real estate, infrastructure. So that's arguably what we're best known for. But interestingly, we approach all those areas from a total portfolio perspective. So I think we bring a nice rounded, balanced view to how those asset classes can be used in portfolios, their benefits and their pitfalls as well. And maybe just finishing up, Meketa is an employee-owned organization. We have 75 employee shareholders, and we have long been huge supporters of the CFA Society and the CAIA. So couldn't be more pleased to kind of support this meeting today.
Wonderful. Well, thanks so much for joining us, Stephen. This will be a really good discussion, and hopefully people will walk away with some good takeaways to bring back to their own organizations. When you were making your opening remarks, you kind of hinted at this, but I'd love for maybe just to spend a little bit of time talking about why private equity makes sense in an investor's portfolios, whether you're talking about total portfolio, as you mentioned, kind of the area of focus, but also just contrasting public markets versus private markets. Why private equity?
Yeah. I'll start with kind of the story of what got us attracted to the asset class in the late 90s and caused us to proactively encourage our clients to invest in the asset class. And many of the reasons that the asset class was attractive to us back then continued to be strong reasons for us in the future. If we turn back the hands on the clock 25 years, many institutional investors were invested predominantly in U.S. stocks and U.S. bonds. By today's standards, portfolios would not have appeared diversified at all. And as those of you who are around will remember, in the late 1990s, there was a huge boom in the stock market. Valuations went to the moon. And one of the biggest concerns that we had as an organization that advises on asset allocation is, was it prudent to allocate 60, 70, 75% of your portfolio to a US stock market, which at that time was trading at 30 plus PE multiples, and something like a third to 40% of the market was technology and telecom and related industries. Didn't feel like a very diversified market didn't feel particularly safe. Private equity as an asset class had been around for a couple of decades by the time the late 90s came around. There were certainly some institutions that were early adopters into the asset class. And so there was already a strong history of experience with private equity as an institutional asset class. It just hadn't been as widely adopted as it is today. At that moment in time, there was a particular valuation discrepancy between public stocks and private equity, where the lofty price to earnings multiples and stocks were not matched by lofty price to EBITDA multiples in private equity. In fact, private equity buyout transactions were happening at historically cheap levels. And so as kind of value-looking investors, we looked at the private equity asset class as really a way to deploy capital in assets that had generative properties to create long-term value for clients, just like the stock market does, but at an entry point that was a lot less expensive. And that was sort of the primary motivation for us to encourage our clients to allocate to the asset class. So if you dig underneath that story a little bit, there's a few themes in there. One of the primary motivations is some illiquidity premium to the asset class. You're getting into an asset class that is either cheaper for dollar of earnings that you're buying in a private company, or an asset class where earnings are expected to grow more sustainably than stocks are. But either way, there's some illiquidity premium that should provide a return advantage over stocks over the long term. Number two, there's diversification rationale. The stock market, even back in the 90s, was very heavily tilted towards a couple of growth sectors. Private equity is a more diversified spectrum of companies. The types of companies that you own in a diversified private equity portfolio reflect much better the actual U.S. economy than the stock market does. That was true back in the 90s. It's even more true today, which I'll get to as well. And then the third reason might be a little cynical, but true nonetheless. For investors who are concerned with mark-to-market volatility in their pension plans or endowments, which after the Pension Protection Act in 2006, most of our clients became very concerned with. Private equity has this very neat valuation policy that means it kind of sidesteps a lot of the psychologically driven volatility in the stock market. So long term, you would expect private equity over a 10 or 20-year period to be up when the stocks are up, down if there's a 10-year down market in stocks. But in the short term, it's going to have a more stable path. And for our clients, what that means is that every dollar you allocate to private equity is a dollar that you expect to return more than stocks, but along the way is going to be they're going to ride a less bumpy road, and that's a valuable attribute as well. So those are the three attributes that really led us into this industry 25 years ago or so, and in retrospect, they've all sort of worked in spades. I mean, the returns of private equity have been extraordinarily strong over the last 25 years. The volatility during weak market periods, whether it be 2000 and through 2002, the global financial crisis, or the COVID 6-week bear market we had, private equity was more stable than stocks during each of those bear markets, and it's helped diversify client portfolios. So it's achieved all of the objectives that we expected it to achieve. Today, when we look back on those same reasons to get into the asset class, they all sort of exist. one would probably, a reasonable person would argue that the return advantage today is more compressed than it was 25 years ago, simply by the virtue of it's a more commonly available asset class to institutions. So it's not as underpriced, it's not as inefficient as it was 25 years ago. But there's still very good reasons why private equity should produce a return higher and meaningfully higher than stocks over long periods of time. The diversification argument is arguably even improved today from where it was 25 years ago, largely because the stock market has continued to evolve over the last couple of decades to a sort of a public finance vehicle that is less and less a logical ultimate exit strategy for profitable private companies, and more a financing engine for unprofitable technology and growth companies. So where in the late 90s, there were, depending on how you count them, 5,000-6,000 common stocks. Today you have between 2,000 and 3,000 common stocks. You don't have the numbers that you had before. And part of that's reflective of the fact that companies that used to go public at a smaller stage are very happy staying privately owned, many of those owned by private equity owners over time. Sarbanes-Oxley, the associated costs and regulations with becoming public has made it much more unattractive for private companies to go public. And private equity has proven itself to be, for many private businesses, a very productive way to maintain their financing and growth over time. So because of that, the private equity marketplace has expanded over the last 20 years, and the public marketplace has sort of contracted. And particularly with smaller stocks that trade publicly, the percentage of small cap stocks that don't make money today is just shocking compared to the percentage of privately held companies that make a profit. So for us in private equity today, a well-diversified, particularly middle market private equity buyout portfolio provides exposure to companies that are more consistently cash flow positive and profitable and growing at a reasonable price than one could achieve by similar investments in small and mid-sized companies in the stock market. So those were the rationales 25 years ago. They continue to be the rationale today. And as most of you, I'm sure, have seen, even with higher interest rates on the margin, the motivation for most of the institutional clients that we work with is to continue to dial up exposure to private markets as institutions continue to see the advantages of private investing and the disadvantages of public stock investing.
That's great, Stephen. I think it really sets the stage and probably teases a couple of the topics that we'll cover here in a bit. You mentioned kind of the diversified nature of your client base that you're working with on the institutional side. I'd be curious, conversations that you're having with some of those asset owners and those allocators after a pretty crazy 2 to 3 years where you had COVID, then inflation, one of the biggest interest rate shocks that we've had in decades really occur over the past 18 months or so. How are they kind of looking at this asset class today versus how they might have been looking at it maybe 3 and even 5 years ago?
Well, I'll first give you my sort of experience broadly, just in talking about the asset class with our clients. For me, it felt like up until about 3 or 4 years ago, maybe right as COVID was starting, most of my time with clients as it related to private equity was spent defending the asset class. Here's why you're invested in it. Here's why there should be a return advantage. Here's why it makes sense to invest in it the way you're investing in it. And defending all of the challenges with the asset class. Yes, the fees are absolutely ridiculous. Yes, the volatility dampening impact is artificial. Yes, there's leverage in these transactions. Yes, owners of private equity general partners are often do abhorrent things in their personal lives. I felt like it was an asset class that most institutions knew they should be invested in, but they had to be constantly reminded of, do we really need to be in here? Like, tell us. That's totally changed. In the last 5 years, almost on a dime, the conversations have shifted to a recognition broadly that private equity is indeed an acknowledged part of an optimal portfolio. It's not a question anymore, should you have private equity or not, and what are the pros, what are the cons? That conversation happens much less today. The conversation is, should it be 5%, 10%, 15%, 20%? It's an allocation question. And then the risks that our clients are looking to mitigate, are less investment-oriented risks. Those are still very relevant, but in the last 20 years, best practices have evolved in portfolio construction of private equity to ensure diversification by vintage year and industry and general partner and all of that stuff. So it's no longer debated the best way to invest in private equity. The methodologies are all clear. People buy into them. And so most of the challenges for boards today, particularly public boards, is how do we best handle the shrapnel that comes from our stakeholders when private equity has negative press? And it gets negative press across a lot of different areas: lack of gender diversity, lack of climate responsiveness, employing child labor, a lot of practices that most reasonable investors just are not perfectly comfortable with. And so the asset class now is on a journey to kind of correct all of those challenges to make itself yet even more comfortable for institutional investors down the road. So getting back to your original question, the dialogue today is mostly about allocation to private equity and whether it should be increased in the current environment, which I kind of hinted to earlier. Is a little ironic. You would think that, you can get 5.5% in cash right now. Why extend into risky assets at all for institutional investors? But it's interesting. I think at the same time, the lesson that institutional investors have learned over the last 20 plus years is that the illiquidity pays off over time. It may not pay off every year or every 5 years, but if you're committed to the asset class and you can commit to it because you have liquidity elsewhere, it's worth investing in it for the long term. So at the margin, we see in this environment, most of our institutional clients either maintaining or even slightly increasing their private equity allocations. Public equity allocations are going down and fixed income are going up. So there are asset allocation changes we see from the changes in interest rates, but interestingly, it's not taking money from private equity. It's at the margins adding to it. And as a final point, part of that is a little bit reactive because almost any institutional investor who's been invested in private equity for the last decade is over-allocated private equity today because it's done so much better than public stocks. So the higher target allocations that many clients are creating in private equity doesn't mean they're going to allocate more capital to the space. It just recognizes the already high allocation that private equity has in the portfolio.
And I was going to ask, because last year, and it was everywhere in the media and seemed like every conversation, the whole denominator effect that occurred with public markets going down so much. Obviously, private equity is not marked as frequently. So I guess we've seen public markets come back, but you're also saying people are kind of over allocated maybe to some degree, but still interested in allocating more. So how have those conversations changed even in an even shorter term horizon, maybe comparing 2022 to where we are in 2023?
So I think we're the decisions that boards are making today are still roughly based on the performance of 2022. And 2022 was a remarkable year, as most of you probably know. Depending on kind of when the fiscal year of the plan was, whether it's December 31 or June 30th. Roughly speaking, you had public stocks down 20% and private equity up 20%. It's a 40 percentage point differential in an equity asset class. So that created the overallocation. That created a lot of confidence in the asset class and a lot of interest in kind of continuing, if not slightly increasing, allocations there. So I think that's still the predominant experience that people have, that the asset class produced a positive return when bonds and stocks were down a lot. And boy, isn't that a good characteristic? I want more of that. So that is still kind of the near term lesson. Private equity this year, depending on kind of what sector you're in, ventures come down quite a bit, largely because of the crypto Bitcoin challenges. But most buyout portfolios, continue to click along this year. They're underperforming public stocks, but not really giving up any significant gains from last year or the last 3 years. So performance continues to be very consistent in the asset class. I'd say probably the biggest discussion point now is less about the economic environment and more about the vehicles and models that are used to get exposed to private companies. The historical model being fund investing. And in fund investing, to make a short story of it, you go out and find good managers, you allocate to their funds that charge 2 and 20. You commit capital to their funds. That capital is called over a 3 to 5 year period and returned to you over a 10 to 15 year period. And you do that every single year, and you build this kind of cash flow machine where distributions that come back in fund the contributions for new funds that you're committing to. And that's been the kind of de facto standard way that institutions have allocated to the space historically. Starting about 5 or 10 years ago, co-investments became a much more popular way for institutions to get exposure to private equity. Co-investments are where the general partner offers to limited partners the ability to invest alongside the general partner in an individual private company at no fee, no carry. So that dollar sidesteps the 2 and 20 structure that fund vehicles charge. And for a long time, co-investments in the co-investment industry didn't grow that significantly because of the sort of obvious concern of adverse selection effect on the part of limited partners. Why would a general partner offer me to invest in a deal if it was a good deal? Because if it was good, they'd put it all in their fund where they get the carry. That was always the concern with co-investments. As time has moved on and people have done studies on co-investment performance versus fund performance, there really isn't any meaningful evidence of adverse selection effect. And if there's no adverse selection effect, really all you're left with is exposure to the same companies without the fee drag that comes with the fund. So many larger institutional investors today are now switching their models to co-investing, and it'll take decades to kind of get portfolios to be predominantly co-investments the way fund structures work. But that's probably the biggest trend we're seeing now in an effort to reduce overall costs in private equity allocations.
And maybe sticking on the access conversation and the vehicle conversation, one of the things that we're focused on quite a bit at CAIA is this whole democratized access. So even going further than co-investments for the institutions, but For a private wealth investor, for a financial advisor, 10 years ago, it was pretty impossible to gain access to, a lot of these strategies. But today, more flavors in private markets, real estate, private credit, are being offered through semi-liquid vehicles, more regulated vehicles. I guess what's your take on the appropriateness for private equity, given that it's a much longer dated asset class where liquidity is tougher to come by than maybe say a private loan or a real estate property with some cash flow? I mean, how do you kind of balance that access for individuals with the fact that these are highly illiquid underlying strategies?
Yeah, I mean, I think it really depends on the individual. So it's hard to make a blanket statement that they're either good or bad for retail investors. My strong sense is that they're really positive for some, and some it's not appropriate. And it depends on the particular situation that an individual investor has. But I'll highlight this in terms of cash flow characteristics and illiquidity. Most institutional clients have regular cash needs every year. If you're endowment, you spend 5% of your endowment every year. Even if you're not fundraising, a lot of endowments still spend that. And so they have a net draw on their endowment that's pretty meaningful. Many endowments with that cash, with a 5% net draw, still allocate 10 or 20% to private equity, and they have for a long time. Defined benefit pension plans in today's world with our demographics, most have between a 2 and a 5% net cash outflow every single year. They're investing, on average, the larger ones, a third of their assets or more in private markets. So for an individual client, they need to be aware of the illiquidity of the asset class. They need to be able to support that illiquidity and truly invest for the long term. But as long as they have liquidity needs that are no worse than the institutional clients that we work with, I don't see a meaningful reason to avoid the asset class. But I think it does come down to kind of cash flow needs and can you manage the illiquidity, because private equity, even with all these tender funds and interval funds that provide some small degree of liquidity, and as you know, Aaron, Meketa sub-advises a private equity interval fund. The first thing we tell advisors is don't invest in this fund if you're going to need liquidity in the next 3 or 4 years. That's not the purpose of the liquidity. It's a parachute if there's a car crash with a client. But the intention of the asset class is really to be long term, regardless of the vehicle that it's in. And it's important for advisors to recognize that, to educate their clients on it, and to communicate regularly with their clients on kind of what to expect from the asset class.
Right. I want to pivot a little bit, and you alluded to some of this in your opening remarks, but if we just go through the different flavors of private equity, maybe just starting with venture. You talked about capital formation and the fact that the number of public companies has shrunk pretty significantly over the past 20 years or so. Companies are staying private longer, or they're not going public at all. Have you noticed any change in kind of the relationship between private markets and public markets in terms of that company's journey from public or from private to public, maybe over the past couple of years, or has that trend really continued, since it started over the past 20 years or so?
Yeah, I guess from broadly speaking, the long-term trend continues to be the short-term trend, which is being a public company has significant liability, regulatory scrutiny, and costs associated with it. There's benefits too, but all those things exist. And as a consequence, many more private companies, whether they're venture or buyout type companies, are choosing to stay private more or less permanently. And, you know, I'm sure if the IPO market opens back up and it's a red hot bull market and prices for public companies are extraordinarily high, it's going to make sense for private owners to exit in the public markets. But the experience has been that those IPO markets aren't consistent. They happen and then the spigot stops for a couple of years. And so if you're running a business, it's hard to, I think it's harder to run it today with sort of a long-term expectation that I'm going to IPO this business. It happens, but I think more likely than not, business owners are focused on EBITDA generation and growth. And am I going to sell my business to a financial buyer or private equity buyer or to a strategic buyer? And I think those are more often the liquidity routes for owners of private businesses. There always has been, and there continues to be a strong opportunity for private equity privatizing public companies. So that will continue anytime the stock market goes down in value and a private equity owner believes that the stock price is undervaluing the business. There's a good value proposition in that. And for corporate spinoffs, you have public companies that spin off divisions and might sell them to private equity as well. So there is sort of a lot of natural connectivity between the private and public markets. There always has been, and I think that continues. But I also think the broader trend is that the public markets are no longer the de facto exit strategy for successful private businesses.
And maybe, I know we're probably 6 months removed from it, but the whole impact of Silicon Valley Bank, I mean, any thoughts on how that's impacted the venture industry specifically?
I don't know if I have any strong observations on Silicon Valley Bank's impact on the venture industry. It certainly showed a lot of venture and private equity general partners that there's risk in your banking relationships, and there's risk in the connectivity between your banking relationships and subscription line financing as well. And so I think that was a lesson learned to a lot of organizations in the space. And I think it highlighted, venture's always been more of a clubby area, and maybe Silicon Valley represents a little bit of the risk of clubbiness. There's a lot of benefits to clubbiness, but maybe Silicon Valley Bank represents, one of the risks of clubbiness as well. Particularly kind of the social media trigger of all of that. But I would say generally on venture, the thesis of venture is probably unchanged from the banking crisis, which is it's proven to be a very effective industry for financing small, usually technology-oriented businesses that are aimed at disrupting the way the economy works. And I think as long as the industry operates in that way and productively in that way, it'll continue to attract institutional capital. But we invest in venture, but I would say when we look at the private equity landscape, venture is definitely a smaller piece. Like the rationale for why you invest in private equity, I think it starts with buyouts, and venture becomes sort of an add-on to kind of a core buyout exposure for the way we view asset allocation.
Yeah. Well, maybe pivoting to buyouts just a little bit. And you talked about this in the beginning a little bit as well, but the rate environment has certainly changed over the past 18 months, and the cost of capital has gone up. I guess how are you kind of working through this environment where, you know, money's not free anymore, trying to make these transactions take on leverage, it's more expensive than it was in the past. What's the impact on some of those transactions? Are they more conservative? What does that capital structure makeup look like in this environment? We'd love your thoughts just on the impact of rates on buyout transactions.
So I'd say the biggest impact that people should be aware of is the higher rates combined with tighter lending policies at banks has created yet another opportunity for private credit to step in. So the private credit industry, you know, which I would argue largely, you know, started developing 15 years ago, and every year it seems like it's grown too big. Now looks like it's too small for all the needs that are out there for financing. So the development of the private credit industry in the U.S. Is just a massive institutional change to how capital is formed and transactions are made, and the higher rates and the stricter lending strategies from banks. First and foremost, it pushes more business to private credit. So the Fed obviously wants to minimize risk in the banking sector. It is, and so the risk is being pushed off to the private credit sector. Private credit has been a phenomenally attractive asset class for institutional investors and for some retail investors. It's got gobs of dry powder, and so many of the private equity transactions today are making more use of private credit sources as opposed to bank lending. So that's the first thing. At least more with private credit than with traditional banking. In terms of the cap structure, based on what we hear from the general partners that we allocate capital to, it's been very interesting because I think most reasonable observers expected that after 2022, when private equity valuations stayed elevated and public stocks and bonds went down, one would have expected transaction values to go down in private equity. And I think they have at the margin, but not anywhere close to kind of where many people thought they would head. So so far, on average, what our observation has been is that transaction values have declined slightly. The amount of debt in transactions has reduced slightly. So if the average transaction was, let's just say, 45% equity and 55% debt a year ago, maybe it's 50-50 now. Transaction value's down a little bit. And so what that means is the IRR they're underwriting to is a little lower than it was a year ago, but not a meaningful impact on transaction valuations. And volumes really haven't been that impacted. Certainly volumes are down the first 9 months of the year, but not as much as you would have thought, given where rates have been. I mean, it's not like the real estate market, which has been seized up in certain sectors. Like private equity transactions are happening, and co-investment flow is just fantastic. So there's a lot of activity, and on a forward-looking basis, it appears like there's a really good pipeline of activity coming up, because to the extent that activity was stunted the last 9 to 12 months because of higher rates than anticipated of a recession, any of that activity that was paused in that environment now has to eventually move forward. So surprisingly to me, the market has not been nearly as impacted as one would have thought going into an environment where rates go up to 5.5%.
Got it. just a reminder to the audience, we've got about 10 to 15 minutes left. So if you do have questions, feel free to put them in the chat. Stephen, one of the things that we haven't talked about yet, and maybe this goes back to your public board conversation to some degree, is just ESG and kind of climate and a lot of these other kind of issues that are not only being faced by the GP, but also from the LP's perspective. So how are you kind of thinking through ESG issues, maybe in particular climate issues in the private equity space? And does private equity kind of lend itself to some of these issues differently than what you might see in the public markets?
Yeah, I mean, the interesting part about private equity versus public equity as it relates to these risk factors is one of the salient differences between the two. In most private equity investments, you're a control investor in a company. Mm. In all public equity investments, you're a small minority investor. You have no say. So in the public investment world, when our clients are engaging with public companies on a variety of risks that they see as shareholders, they're voting proxies. They're doing shareholder resolutions, really kind of minimal stuff that is hard to move the needle on. It's worth doing, but you're not going to change easily how companies do business. In the private equity world, private equity general partners usually control the companies. They own more than 50%. So they are in a position to act on some of the wishes of limited partners. So I'd say the most important element of sustainability factors and risk factors for our institutional clients with respect to private equity is that the industry is approached on a collaborative basis, not by any one fund. Because there's a fear in the industry that if a pension plan places too many demands on a private equity manager, the private equity manager could find capital elsewhere, and that's not helpful for engagement. So most of our clients work through an industry organization, ILPA, Institutional Limited Partners Organization, to communicate with the general partner community on concerns and issues around climate, diversity, board diversity, labor, et cetera. And that tends to be the most frequent path that institutional clients take. And the first, just kind of stepping back a second, the first goal of investors when they're addressing sustainability risk factors like climate is you can't manage what you don't measure. So the first job is like measuring it. And we're at that stage right now. And we kind of are in the public companies as well. So ILPA, with the assistance of some large general partners and large asset owners, has adopted a data collection template to collect data on emissions for climate and labor policies for labor and diversity statistics and policies for diverse DEI issues. And that's where large asset owners are engaging with the general partner community today through the collection of all of that data. And so we're still, I guess to say, we're still in the early stages of engagement in ESG factors in private equity.
Great. Well, Stephen, we do have a question that came through that relates to what you were talking about with co-investments. And the question just says, how do GPs decide whether or not to include co-investments as an option when investing in their fund?
So I would say 10 to 15 years ago, co-investments were largely a way for general partners to give a fee break to their largest clients. Because what's precious to general partners is the 2 and 20 model. They don't want to negotiate off that. They want to be able to tell all their clients, you're all playing the same super high fee on the fund. But economics make it obvious. You want to make sure your largest clients are happy. So in lieu of negotiating the 2 and 20 down for the largest clients, they'll instead say for every dollar of capital you allocate to our fund at 2 and 20, you get $1 of co-investments. So there was typically a policy like that, and that still exists with many private equity managers. But the interesting evolution is more recently with a lot of general partners, they're not the co-investment capital is so valuable to them. They need it as part of how they put the capital together to transact a deal. In the absence of it, they got to go find the capital somewhere else. And it used to be they would find it from their competitors, and their competitors want board seats and all this. So co-investment capital to general partners is really valuable because it doesn't come with strings. It's a friendly limited partner. You're providing your the capital. You're not asking for board seats. You're not asking for any additional data or information, and you're not a competitor. So increasingly, private equity managers view co-investments more as a financing tool, and less as a client service tool or a marketing tool. And it's now becoming just part of the landscape of how you execute a deal. And if you have a strong relationship with a general partner, you're on their list to call every time they're doing a deal.
We have another question for you. So given the rate environment and the increased cost of capital, but also some increased efficiency, are there certain areas of the buyout market that you all are focused on, maybe differently than you were before? Where's kind of your area of focus?
It's really been, it's a boring answer. It's really been unchanged for the last 25 years. We continue to focus primarily on middle market buyout. We invest more broadly than that, but to us, because of the rationale that Meketa brings to our clients on why invest in private equity, that's the part of the market where we believe you get the best diversification from your public stock portfolio. It's the part of the market where if there is inefficiency in pricing of private companies, you're more likely to find it there. And it's the part of the market where control investors in private companies are more likely to be able to implement changes in the companies to create value for shareholders.
Well, maybe in the last couple of minutes, Stephen, would love to just hear from you. Just what are you most excited about in this space, and then what are you most nervous about?
Well, most excited about the democratization element that you kind of hit on before. It's sort of a new frontier for private equity. Meketa, as you know, sub-advises the Primark Private Equity Investments Fund, which is a point-and-click solution for private equity exposure for RIAs. It's largely a co-investment vehicle, so it sidesteps all the fees. It's a very interesting, novel, and cutting-edge approach to allocating to private equity in an operationally simple way. And I think you're going to see more of that in the marketplace across the private markets. I think from what I hear from the RIA community, there's just a growing demand and acceptance for exposure to these types of asset classes that institutions have invested in for a couple of decades. The biggest concern about the industry, I would say two things longer term. At some point, I think general partners will have to break the 2 and 20 model, and if they don't, the asset class will become less and less attractive over time, because what investors obviously are interested in is net of fee returns. And that 2 and 20 model, as I'm sure some in your audience know, it creates a fee drag of 8, 9, 10% on your portfolio, and that's just not acceptable long term. Co-investments are a nice way to moderate that at the margins, but I think longer term general partners have to really think about the impact of fees on investors and the attractiveness of the asset class. And the only other fear I would have is that it's not really. I think it's a very low probability that regulation turns the other way, and all of a sudden, being a publicly owned company becomes a lot more attractive. There's less regulatory scrutiny, less liability, less costs. That's really the risk to private equity. But gosh, the pendulum's swinging the other direction. There's more regulation every day. There's more costs. There's more issues of being a public company. So that's always a fear, but it's not at this moment in time a high probability one.
Right. Well, Stephen, thanks so much for your insights and your time. Hopefully the audience walked away with some helpful information to the asset class and to the industry, but lots of good topics covered today. So thanks again.
You bet. Thanks, Aaron. Thanks, everyone.